Okay, so we're recording. All right, so yeah, guys, like I mentioned, I just wanted to take a little time to give everyone a chance to get some questions answered and just show you one or two strategies really quickly. I don't really want this to be very long, so I'm just gonna kind of jump straight into some questions that I got today. I know Carolyn had asked me a question. I think Aluko, you had pointed this one out to me yesterday. Take profit. Okay. Adjust the point of entry and stop loss and take profit. Also, I'm not sure what it is, but usually one sees buy one to a number ratio and under. Okay. All right. So first question that I have here sent to me is on take profit, stop loss, and also when you're buying the lot size and so on. So let me just go right ahead and get into that first and foremost. In terms of the lot size, when you're buying a trade, okay, or you're looking to buy into a trade, let me just, this is a demo account here. Just open this up. All right. So if you're looking to buy into a trade, you can, if I click here on new order at the top, okay, you're going to see the symbol of the pair. You're going to see the volume. All right. Now, the volume represents how much lots that you actually want to purchase. You can do, if you do one lot, all right, you can do one lot. I wouldn't suggest doing one lot unless you have a couple $1,000s in your account or you're very much sure about what you're doing. I would suggest using smaller lots. If you're doing like under 400 and 500 US dollars, 0.01 to 0.02. Again, I wouldn't suggest going much higher than that until your account starts to build up. All right. When you start to understand what you're doing and you're trading on your own, and you're seeing consistent wins, then you increase your lot size. This is one of the things that causes a lot of people to lose quite a lot of money. They over leverage, and if you over leverage and you use lot sizes way too big, you can blow your account very, very quickly. All right, so you just want to always keep that in mind. Okay, what the broker that you are using does is they give you that leverage to. It works out good for them, but it works out good for you as well, because it's kind of like getting a loan, so to speak, from the broker. All right. So if you're leveraging 1 to 1,000, it means that for every dollar you've got in there, basically the broker's lending you extra $100 on top of that, $1,000 on top of that. So if you have $1,000 in my account, but I'm leveraging 1 to 1,000. Well, you can multiply that and you will see that you have a lot more to work with, so to speak. Now, that also increases your equity, but it is not really your money, even though you can make money on it. It is taken back out daily, okay? So just keep that in mind. You get bonus, especially if you trade this way. You get bonus and so on, but you want to make sure that you don't let your equity drop too low, all right? So for Carolyn, I asked, what are the numbers that you're seeing? Those are the lot sizes. And you always want to use risk management and choose very, very wisely. Also, was asked about stop loss and take profit. Okay, let me explain what those are. Let's come back. Let me just go ahead and mute everyone. Okay, good. All right. Stop loss basically means, this is a point that you would set on your trade so that in the event that your trade goes in the direction you don't want it to go, goes against you, it stops the trade. It jumps you out of the trade, and it stops your losses from increasing, as the name suggests, stop loss. Okay? So if you wanted the trade to go up, and it started to go up, but then it swung back down, and you have a stop loss set, it will come back down to the point of that stop loss, and it will jump you out of the trade to avoid you losing a lot more money. A take profit now is the inverse of that, where you set a point above or below based on if you're buying or selling. Let's just say a point ahead of the direction you want it to go in, and when that point is achieved, it triggers the take profit, and it jumps you out of the trade, and it takes whatever profit that you have accumulated so far. Now the trade may continue to go in that same direction, which means you could have made more money, But if you set a take profit, it's going to jump you at that specific point. Okay. So that is what a take profit and stop loss is. Let me give an example here based on the actual chart. Okay. Just move this from here. So let me just move some of these lines from off my screen for you, so that you can probably just kind of see a naked chart. Now, for you guys, what I've probably mentioned before, I trade naked, and by that I mean the chart. Let's not get carried away. I mean the chart is naked. The chart doesn't have a lot of indicators and so on. So when you hear about naked trading, I assure you that is not to be taken literal. It means the chart doesn't have much other indicators and so on, okay? All right, so real quick, here's an example. Let's say that you bought in a trade, right here, okay? So I'm gonna put a line here, horizontal line here. So let's say that you bought into this trade right here, and you expected it to go down. So it's coming down, coming down, coming down. Your take profit, let's say you set your take profit down here, right at this point. It means that when you reach this point here, the trade will stop. The order ends, you're taken out of the trade, and whatever profit you have on the write down is yours. Your stop loss, you might have set just above here, okay? Which means in the event that this trade had went back up, it will jump you out of the trade. The trade closes and you don't lose as much money, okay? Very, very simple to explain. That's what a stop loss and a take profit is, all right? So that covers that. Are there any other questions that you guys want me to cover before I kind of get into the charting of and so on? Again, you can type it or you can unmute your mic and you can ask that question.
Hey, Vera.
Hi.
Yeah.
This is
Winfield.
Hey, Winfield, what's up?
Hey, yes, buddy. Okay. I see you using the 14-day moving average. What's the difference between that and the 20? I think it's exponential moving average. What's the difference for them there?
Okay. Yeah, there's 14. Right now I use 14, 20, and 200. All exponential. You can have it simple, you can have it lightly weighted, or you can have exponential. Basically the moving average just gives you the 14. If I use the 14 moving average, that's the last 14 price points divided by 14. So the higher the moving average, the more price points you're calculating, and based on the amount of data. So you're going way back and calculating more data based on that. Which is why you have the 200 moving average is obviously then 200 price points before divided by 200 based on previous historical data. So that now gives you more information, and the 200 I use as support or resistance.
Yeah.
So based on the price points, it tells me that for this particular period here, right, as it's flowing, and it's a moving average, so it moves along with the period itself. And sometimes it's support, as you can see here. Other times it's resistance, as you see here.
Okay. Yeah.
So the 14, I like the 14 because it trends closer to the actual candles of itself. And so it gives you a very good idea as to the current directional trend. Yeah?
Okay.
The 50 also acts as a support resistance type of line. So you will find the 50 would in some cases have support, which is resistance here, resistance, support, resistance, and when it goes under, support. If you look at the support, you realize that the candles are actually bouncing on that support line as well.
Okay.
You see that? Look right here again. Bouncing off 50 as the support. You might get some breakthroughs every now and then through the 50. That's perfectly okay. All right. But all in all, it gives you a much better idea as to the support of the particular trend. The 200 now gives you direction. So the thing is, if you realize I'm trading here on I use the 15-minute chart a lot more now. This is actually a strategy taught to me by one of my mentors, who does extremely well. He's been trading for a couple of years, and he taught this strategy to me. Right? The 200 acts as an indicator for the directional trend that you're looking at. So this would tell me based on this now, if you see it's going up, it tells me it's an
Yeah.
upward trend, right? And it's going down,
Okay.
it says downward trend. If I'm using bigger time frames like the H1, H4, D1, weekly, I would use those to identify for larger charting patterns. If I'm doing like a H4, if I'm trading on the H4 or H1, but on the
Yeah.
15 minute it's so short and quick that I really don't even need to do a lot of that anymore. So
Oh yeah.
so I actually just use 15 now.
Nice.
Yeah, so those are the differences.
Oh, okay. Thanks, bro.
Not a problem, man. All right, so let's see. Okay, so let's look at some different charting patterns. Okay, I'm going to show you guys about two of my favorite that I use, and I think if you understand them, then you can make some pretty good money using them. All right, so this particular trade, this is Euro JPY. I'm just going to choose any other one. Let's go with AUD JPY. Okay, it really doesn't matter. The same principles apply, really. All right, so one of the first things that you still want to do, you want to identify what direction that the particular pair is going in. Again, if you're on the 15, if you got the 200 moving average, that kind of gives you an idea. I can see clearly this is a downward pattern here. Down, 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 down. That's one of the first things you want to look for. Second thing that you want to look for is the signs. You want to look for those M's and you want to look for those W's. Can anyone tell me what does a M or a W actually indicate to you? Anyone? If you start to see M's and W's in your chart, what are some of the things that those actually indicate to you? M's or W's?
Well, to me, the M means it's going up and the W means it's going down.
Okay. All right. Who's that that's speaking?
Malcolm.
Hey, Malcolm. Okay, good stuff. All right. Anyone else? Okay. Matley say reversal. Okay. So we got M is going up, W is going down. We got reversal. Any other takers? All right. So for the sake of time, I'm just going to tell you the W. When you have a W formation, it's usually going up, and M is generally coming down. So Malcolm, you were close, but you had them mixed up. All right. So W is up and M is down. Actually, let's put that to the test. Let's see if you can find some W's. And one of the best things, so if you want to find M's and W's, guys, just zoom out. It's so much easier when you zoom out. You start to see things so much clearer. Here's the W. Look at this. I want you to see this. Down, up, down, shoots up. It actually moves right into another W, which comes down, first leg, second leg, third leg, shoots right up again. You guys see that? Now,
Yes.
that
Yes.
actually goes into, so this is actually a multi-session M and W for period. Because if you watch this carefully, it goes up and forms an M. First leg, down, third leg, and then check the last leg of the M. Shoots right down. Comes right down into a W. Down, up, down, shoots up. See what's happening there? So here's another one. W. Down, up, down, shoots right up. Okay? So M's usually going to give you a downward pattern, a downward formation. W's generally give you an upward pattern. Check this out again. Down, up, down, and all the way down. But then check the retracement. All the way up. Actually, if you were to count that in pips, that's about 62 pips right there. And this is a 15-minute chart. Okay?
Wow.
So, yeah. So you just got to watch for those. Watch out for M's and W's. M's and W's. Just always look for those patterns. M's and W's. And it's always better if you can catch it on the last leg, because if you can catch it, if you catch it on the second leg, it may not necessarily become an M or W. It may just be, a movement. But if you can catch it on that third leg, with the W, first leg, second leg, third leg, it's highly likely that you're looking at a W formation, okay? All right. Another thing that will tell you that you're seeing a W formation, you might see what we call a inverted double peaks, right? Let me see if we can find one here. So you're looking for those double peaks. Okay, here's a double peak. All right. This is a double top. Check this out. It's an M. Up, down, up. Shoots down. All right. Let's look for another one. This is actually one here too. This is a W. I don't know if you guys can see.
W, yes, at the bottom. Yes.
Here's a trick. Switch to line view. How much more clear is that now? To see those W's and M's. Bet you guys didn't even notice this is one here as well. If I go back to candles. Okay, well, yeah, you can tell that that is one right there. Here's another. Oh, moves too fast. Here's another one. You see, when you switch to line view, it makes everything so much clearer. There's another W pattern right here. And if you caught that on the third leg and you wrote it right up, 93 pips.
Wow.
Right there. 93 pips.
On a 15-minute chart.
Okay, so start to use line view, guys. I use line view all the time, So let me guys show you another trick. All right, well, not really a trick, really, but just another thing to look out for. So one of the things that people are always curious about is, you know, when do I buy into a trade? When do I jump out? How do I know where to set my take profit? How do I know where to set my stop loss? I like to trade breakouts, all right? I trade EMAs and I trade breakouts. Let me explain the breakout strategy first. I usually use the breakout strategy on H1. I just kind of like H1. But because I've been using the ECR, I've been using the moving averages strategy, I've just been doing it on the 15 as well, okay? And it can work pretty much on any chart. It's a massive W here, look. Huge, huge. Okay, anyhow, so let's zoom in a little closer and show you guys how this could work. Let's say that, let me come back a little bit. Okay, so it's kind of rugged here. All right, so let's say we've got this happening. We're just gonna work with this part of the screen here, and we're just gonna pick up some trades around here. So we've got this part of the screen, and you know, you're now coming into the market, and you say, okay, you know, this is happening over here. What do I do? What do I buy in? Here's what I like to do. First, I check my directional trend. Is it up? Is it down? Is it lateral? If it's lateral, I generally don't trade. By lateral, I mean if it's just going sideways. Okay? It's never a good idea to trade sideways unless you're scalping. If you're scalping, fine. Because scalping, you just look at those 5 minutes, you're just jumping in, jumping out, jumping in, jumping out. And it's just going to be kind of moving like this in a zigzag. All right? But if you're really looking for big pips, no, don't trade when it's going sideways at all. You want to trade when you've got some volatility. It's going up, it's going down, it's making movements in either direction. Okay. So here's what I like to do: I find my chart directional trend, see where that's going, and then I switch to line view. Now, if I came into the market, open up the charts, and I saw this, I would switch the charts real quick. Why? If you came in and this is what you saw, can anyone tell me why would it be probably not a good idea to trade this particular trade right now?
Because I am seeing a lot of M's.
Okay.
To the top.
All right. A lot of M's to the top. Any other takers? Not saying you're wrong, but any other takers? You can type it or you can unmute yourself, guys. Let's make this interactive. So we got a lot of M's to the top.
The 200 moving average, right in this area, that level almost level off. And you say not to trade when it's like going sideways. Always trade when it's either going down or going upward.
Okay. All right. So we've got lateral movements and we've got a lot of M's. You see, Aluko says consolidation period. Bingo. Bingo. That's the answer right there. Guys, this is extremely choppy. See this?
Yeah.
Up, down, up, down, up, down. There's no solid movements. It's just up, down, up. Too much zigzags, too much peaks, too much spikes, too much chopping. I would not trade that at all. Okay? Way too choppy. All right? Again, unless you're scalping, you don't want to get into that as yet. There's absolutely nothing wrong with switching to a different peer. There are hundreds of listen. There's so many peers to choose from. You do not have to focus on any one specific peer and spend all your time looking at that. Okay. Now, obviously, you still don't want to be trading too much different peers at a time. But at the same time, it's better to wait than to get into a choppy peer and mess yourselves up. Okay? So good stuff. Now, we show what we look at. And this is just for example purposes here. If I were to look at this chart here, and I wanted to do some take profits and stop points and so on, here's what you do. Every time you see a peak, that is a break point, guys. So I would be coming like this. Boom. If I were here right now, if I was in this position, okay, you know, or anywhere in here, I'll be setting these take points. I'm going to put a mark there. We put in marks up there. And let's say, for example, let's go to the end of this actually. So this is where it actually is right now, okay? This is demo. I don't know, the market is probably open by now, I think. Yep, we're seeing some stuff moving. Yeah, markets are open. So check this out. This particular pair right now is heading down. All right, got a slight downward movement there, coming off of what potentially was based on a higher time frame. This would be a big W. But here's the thing: what will I be looking for? Here's what I do: I switch to my line chart. I'm going to be looking to the left. Always remember that. You look to the left. Find the last points. I'm going to take my horizontal line. I'm going to mark out down here. Why? That's a big stop point. Is what we call true support. Here's another peak. See all these spikes? I'm marking them out right there. The pair is right here at the point in time, okay? Whether you switch to candles or whether you're on a line chart. But I'm going to switch here. What the line chart does, it removes the wicks. If you've got candles, you don't see those wicks. For example, look at this right here. You see this? It starts right there and there. Let's switch over to candle. See the difference? These big long wicks are sticking out. Well, one of the things that I pay a lot more attention to is the actual body of the candle versus the wicks. The wicks are fakes. Just remember that. Wicks are fake outs. They're there for one sole purpose, and that is to steal your money. To stop you out is what we call stop hunting. Stop hunting is where the market makers and brokers and so on, they give you an indication that may make you think that a particular pair is going in a particular direction or continuing in a particular direction. You jump into that, and as you jump into that, for example, if you look here, this is a major downtrend. Down, down, down. 3 big pushes. Boom. 1, 2, 3. 4th push. Now you're like, oh my goodness, I might be, this thing is really shooting down with the 4th candle. I need to get into this and make some money. This thing is shooting down hard. You jump in on this candle. By the time you do that, it's pushing down, pushing down. Guess what? Reversal. All right? Always remember, whenever you see a wick, that is an indication of market exhaustion. In other words, that is your sign of the peer telling you, hey, we're getting tired and just going in this direction. We're about to make some move and turn around. I can prove that. Every time you see a wick in one direction, look and see if you don't notice that the next candle is in the opposite direction. Check it out. All right? You got this big downward movement here. It's pushing. It started from here as a small wick. It got bigger. Then check this. Push right up. Green candle. Then you had the next candle here now. Another big wick pushing it what? Back down. To what? A red candle again. Then you've got a wick pushing it what? Back up. To a green. Up to a green. Then look what happened here again. All right? After the green, okay, you've got a slight red, but it never ever went back down. It just pushes right up. A wick is your indicator that you've reached market exhaustion for that particular direction. Okay? So 2 things that I want you guys to remember very, very carefully. You want to identify your true support and your true resistance. Now there's difference between true and just resistance. True support and just support, true resistance and just resistance. For example, if you look at this pair right here, all right, I can easily say, I can take a line and I can put it right here and I can say, okay, boom, that's support. And it is. Because, it came here, it bounced off this, and it bounced back up. I can switch to line view. I can say this is support. Okay? It's below the candles. But is it true support? It's not. Your true support is actually down here, right? This is where your true support is. Yeah, this is where your true support is.
Is
So,
it because that's the codec went?
I didn't hear that.
Is it because that's the codec went? That's the true support?
That's the very bottom of that current section of data, right? You don't want to go all the way back, all the way back, all the way back, and say, oh, I found a point that's lower than that. So that other point, no, that's not what you're looking at. We're working on a 15-minute chart, so you don't really need all of that data. You don't need all that information back there. Why? For what? You're not trading daily or weekly or monthly. We trade on 15 minutes. All right. So you want to get the current data that's going to tell you what's going to happen to this trend in this period of time. Okay.
Yes.
So you've got your true support here, and you've got your true resistance. All right. So those are things you want to pay attention to. But outside of that, like I said, once you identify your true support, your true resistance, then you also want to pay attention to the things that the chart is telling you, like the wicks. You're always going to notice that you're going to get a lot of wicks when you get in the areas of true support and true resistance, and you're going to get some reversals as well. If you use certain indicators, like for example RSI or even the stochastics, they can always also kind of tell you, but sometimes you can get tricked. Because you might see RSI aiming right down, and you think, well, good, it's under 30, it's going to swing and go back up. Not all the time. Because if you look at the chart, you just read the naked chart, you might realize, well, shoot, I'm not yet at true support. So maybe at the bottom, you think it's going to swing. It doesn't, because it's going to come right down. It's going to respect true support. Then it's going to make that move back up. Let me show you guys something else. You guys understand this so far?
Yes.
Okay. All right. So here's what I do. Switch the line chart. I'm marking up my points. I'm looking at what's going on here. So my thing would be, if I'm looking at this pair, all right, I'm going to be looking at, so far, the last high point was right here. Then I'm going to look at, I'm going to say, well, hey, okay, I've got a point right here as well. All right, this is kind of smoothed over, but this is actually a sharp point. So my analysis will be telling me, well, okay, let's look at this. I've got the 200 moving average above, which tells me that this is kind of a pushing down, kind of a bearish potential move. Okay, I think I got it. Okay, cool. All right. So this is telling me we've got a potentially bearish movement, okay? Potentially. But at the same time, if you check it out, it bounced here on true support once. It bounced here again. Actually, you know what? For this particular trend up there, it might not be. You got two touches here. This is probably more so your true support around here. Okay? Now, check this out. You see this little W right here? It pushed up. Let's switch to the candle view. What did it do? It touched that line. Why did it touch that line? Because that line, if we switch back again to line view, that line is where the last touch was. That is your resistance right there. Now remember, I said you always look to the left. If you go back to the left, it touched it there. You realize it touched it here as well. We had a W formation. Came down, came up to where? Very same line again. Do you guys also notice that it bounces right where the 14 MA passes through? It bounced on that line as resistance. It came back down. Then it broke through that line. That is what you're looking for. When you see a breakthrough of a stop point, that is your indication that you're looking for a potential breakout. Okay? Look what happened. Oh, here it goes right across. It touched this line again. We had it come down. When it first came down from this section up here, it came down, it hit this line, it broke through. Came down to the second break point. You notice that this is where another peak is. You guys picking this up? So we got a peak there, all right? We got a peak here. It touched this, it bounces. It goes up, okay? And it gives you some retracement. Just above, just below, but it bounces back again. Hits that line. But here's the thing. If you look at the direction of this trend here, what direction was that? Upward or downward? Bearish or bullish?
W is up.
W is up, but what direction are we going in right now? Based on this section right here. What direction is this going?
It looks like a buy.
Nah, it's a sell.
A sell?
Because if you check it coming from here, all right, all the way down. All the way down.
Means it, oh.
So it's heading all the way down. Even
Down,
though
so
you've
it's
got
a
some
sell.
retracements, and you're gonna get those retracements generally when you hit those breakpoints. I just want you guys to understand why it's important to understand those breakpoints and pay attention to them. Look, it's here again. It was touched. Okay. So the thing is, if you can identify those points, those key points, that's where the bounces happen, and you want to trade the bounces. So you've got some movements here, but the overall trend in this for this particular set of data we're looking at was downward. So what happened? It pushed down, retraced, pushed down, retraced, pushed down. Actually, if you look at this is actually an M right here. Do you guys see that?
Yes. But it's kind of tricky. It's a bit tricky.
You got,
but it's
right.
an M.
It would be even trickier if you were looking at it just as candles. You don't even notice
candles.
it.
Yes.
You don't even see it. Now, this is why that I like to switch to candle view. It makes things so much easier to pick up. You can't even tell as an N. You switch the line, you can see what's happening. Up, first leg, second leg, third leg, push down. It gives you a retracement, but the retracement, when you look at the overall length of this movement from here to here, okay, 402 points, okay? Then we've got a retracement from here to here. How much percentage of this entire movement would you say is this movement right here? What percentage of that would you say it is? I would tell you about 15%. Because if you've got from up here all the way to here, okay, but then you've got from here to here, if you were to draw a line across from that point, okay, from that point, okay, back down to here, probably about 10 to 15%. Would you say that this particular movement is any threat, even though it's going back up? Would you say this particular movement is enough threat to this movement on the way down to challenge it? No, it's not. Not even close. So in other words, what this just told you, what these candles and these charts just told you is, I'm coming down, I'm going to retrace, I'm coming down, I'm going to try to push up. Not strong enough. Back down, got to respect it. But I'm going to try again. Not strong enough. Guess what? Not strong enough, back down again. Let me try one more time. Still not strong enough. Here's another indicator that you probably didn't pick up on. If I were to take a trend line and draw it from here to here, what direction is this going? Downward. Lower lows. Every time it tries, it's a lower and lower low, which means it's losing strength. You guys got that? That's what I'm telling you. It's losing strength. It's coming down. Now, you might have said, oh, it's going back up. Possible retracement, big retracement. Not really. Up, down. Even when it came back up, it was lesser than the first retracement. It came down again, came back up, lesser again than the second retracement. That is your sign right there that this is going to do a serious breakout. You've got the M formation, you've got the overall trend, and you've got 3 retests. Touch, retest, confirm, breakout. And look what happened. It shoots all the way down. Now, it could have hit this point. You might have said, well, okay, you know, this is a break point here. All right? Check this out. See what it did? I went to the left. You see that point was respected. You always look to the left. It was respected here, here, here. This almost touched it. If I put this, it's going to be a line through it. Boom. See what I'm saying? So nothing wrong with switching back. This line was respected. So that's an important point. You mark that. So check what happens. It comes right down, breaks this point, breaks this point. Once it breaks it, you know it's going to go further down. And it did. Not much. It went on to this point here. Retracement. Was it enough to threaten this movement again? No, it wasn't. So it respected the overall trend. But guess what? You're in, what do you call this section? True support. True support. It reached true support. Guess what? Now you've got a W formation. Remember, it retraced up. First leg, second leg, third leg. W formation was starting to form. So you know this is looking for movement up. It shoots
Up.
up.
Yes.
Yes. Retracement. There's always going to be a retracement when you have a push. It doesn't mean to get scared and jump out. It's just the way it goes. Pushes up, retracement. Pushes up, retracement. Pushes up, retracement. Pushes up. Okay? And in this case now, it starts to come back down. How do you know that it's going to come back down? Switch the candle view. What do you see? What are the signs?
The week, the long week,
It's right there in front
almost
of
to
you.
the true support.
The charts tell you exactly what you're looking at here.
Correct. You know, you got the long wick.
Yeah, they
So
tell you.
once you got that long wick, you can go in the opposite direction.
Yeah, it's telling you, hey, we're getting exhausted.
Yeah.
It pushes back down. So that's what I'm saying, guys. All you got to do is just pay attention to what the charts are telling you. They speak to you. All right? They speak to you. Now, I talk about the breakout points. You hit those breakout points. As soon as that breakout point is burst, you have a potential breakout. All right? It's going to shoot somewhere. If you look at this chart over here, that's this candle over here forming. This is what's happening right now. Now, this is lateral movement. Today is Sunday, 1. This is Asian period, 2. Tomorrow is a holiday, 3. So right now, you're going to get some lateral movements. You're going to get a lot of wicks. That is the market makers looking to collect money between now and about 3:30. Between now till about 3:30 tomorrow morning. They're looking to just collect money. So people who would have had stuff in from last week that they forgot to close or they didn't close. Oh yeah, they're looking to collect some money. Stop you out, wicks and so on. It's going to start to happen. Don't worry about it. It's going to happen. All right. Now this is potentially showing that this could go either way, up or down. 200 is above, so it could go down. Another reason why I would personally think that it just may go down is because, well, one, apart from the 200, it broke this stop point here twice. It broke it, retraced, back. Oops, I moved it. Right, it came down, broke it, retraced, back down again. All right, got a little W. It broke it, but it came right back down again. It may hit it, okay, as resistance, and then shoot right back down. Okay, so you gotta look. Let's go a little further. Let's go to a different chart altogether. Your CAD. All right, so jumped into this pair. Let's look at some more breakpoints and so on. Then I'm going to show you the second strategy. Times it. Wow, really? Already? I can't believe that time's gone already. Okay, so again, one more time. You look at the chart, change the line. You're anywhere around here. First thing you want to do, you check, is it up or down? 200 moving average tells me this is pushing down. If you've got a strong downward movement, you really don't want to do a lot of buys on that particular trend. Period, point blank. The reason for that is it might be going down at sometimes. Yeah, you're going to make some money, but you're going to get a lot of swings back up because it's going to respect. Sorry, if it's going down, you don't want to do a lot of buys, because if you do a lot of buys, it's going to respect the trend. It's going to push back down, so you're going to get some retracements. All right. So again, you're anywhere around here. Mark your points. Boom. Just mark the points out. Mark the points out. That's an important point right there. Candle is coming down. Okay, candle is coming down. It breaks it. It's highly likely to keep going down. This acts as support. Check this out. There's nothing under there. Nothing under there. Nothing at all. Okay, that's your current support. Also, these lines that we're drawing, these can be used as your take profit lines as well, by the way. Okay, so if I'm coming down from up here, hit these points, break it. You realize it breaks it, kind of goes lateral for a while across here. And guess what? It comes down. You get some back up, back down, back up, back down, back up, lateral, up. But at the end of the day, has it really gone right back up, or is it still coming down? Despite all of this that's going on, up, down, up, down, up, down, left, right, is it going up or down?
Still coming down.
Still coming down. Why? Because it's already broken. Check it. It's already broken at this point, that last break stop point. So it's just going to play around and double, but at the end of the day, the general direction will be to try to touch the second or the next lower stop point. And that's just what it did. Came down, all right, broke, touched, reversed, retracement, retest, back down, okay? So we got a slight M right there, all right? Not major points. Could hardly even tell it that was an M, okay? But here's what it does. It shot right back up, broke resistance, okay? It broke that resistance, went up a bit, and then did what? Once it breaks it, it's going back to the next point. And that's one of the things that I like about this particular strategy. If I'm coming down when it breaks the stop point, I know it's highly likely it's coming all the way down to here. So this movement alone, I would have made 38 pips. Easy, okay? And we still only 15. I usually do this with H1, by the way. But, we're just keeping it simple here. It came down, then it went back up and broke it again. Okay, great. It broke it. How much did that give me? If I rode that all the way up, here's the thing. It goes up. Now, some people might have tried to jump up when it started to come back down here. Maybe. But another strategy now, you could have actually just said, hey, okay, let me just ride this. It hasn't come back down and broken my stop point. So let me see what it's going to do. It goes up, you make some money, comes back down, you lose a bit, you make some back. Then it gets here, you're like, oh my God, it's about to come right back under. I'm going to lose all the profit I just made. And you were presumptuous. Then it goes right back up, down, and it rides all up here. And look what happens. 37 pips. All you needed to do was just remain patient. Okay? Does everybody understand how to use the breakpoint so far? How to mark them out? Look for the spikes, look for the peaks, all those important points. And those are the points that when they are broken, it's going to push to the second point. If it breaks it again, third point. Breaks it again, fourth point. Take profit 1, take profit 2, take profit 3, potentially take profit 4. Okay? Very, very simple stuff. Now, let me show you guys, actually before we even do that, any questions based on anything that I just said? Okay, not a problem. Let's look at EMA strategy. Now, this strategy, like I said, this has now become one of my favorite strategies, taught to me by a very good friend and mentor. And this is so crazy powerful. It is ridiculous. Basically, this strategy doesn't use any indicators or anything of that sort. You're just using moving averages. Basically, those moving averages, you've got your 50, your 40, your 200, and what you're just looking for is the crosses. For example, you got the cross right here. If you look carefully, when the 14 is below the 50, the candles are down. When it crosses and you've got the 50, the 14 above the 50, candles are up. Pretty straightforward, right? 50 below, candles are down. All right, we can go back to any point in time in history. 14 below, candles are down. 14 above, candles are up. Okay? So what you do, you look for the crosses. Now, how you basically work this is, when you get that cross, remember I spoke to you guys about the retracement. You always want to wait for the retracement. So, for example, let's say came in, you looked at this, you're around here, then you got the cross. You do not just buy in when you get that cross. That could be a recipe for disaster. What you want to do is you want to wait for the retracement, and you just want to kind of watch it for a little bit. This would not be a good example here because obviously it crossed here, it shot up, and then it shot right back down. I wouldn't do it because when it crossed, these lines are still way too close. I would not look at that. Okay? Here's a better example. So we got a huge downward movement, then we got a huge upward movement. I don't know if this was NFP or what, but either way, this is a massive candle here. All right, but right after that, we got a cross. Okay, now here's something that you want to pay attention to as well. Just gonna kind of go through this pretty quickly because I really don't want to go on. I don't want to go over an hour. I didn't even want to go this long. Okay, naked chart. You found the cross, 14 above the 15. Here's what you do. When it crosses, you're looking for that retracement. You do not just jump in the trade, okay? You do see it's an upward movement, it's an upward trend. But what you do is, after you get that candle going up, you wait for the retracement on the sell candle. You always buy on a sell, and you always sell on a buy. And the reason that you buy on a sell is because if you're going to buy, you want to get from as low a point as possible and just ride it up. If you're going to buy on a sell, if you're selling, you want to sell on a buy candle because you want to get as high as possible and then you want to write it all the way down. Does that make sense?
Yeah.
That makes sense, you guys? You buy on the sell and you sell on the buy to get the best possible, as much as possible.
Yeah, makes sense.
Okay, good. So here's what you do. So you get the cross. When you cross, you see the upward movement. That is not your alert to buy. What you're waiting for is this, the retracement down. Now you do not buy until that candle has closed. The reason for that is this candle may close below your 14 or your 15. Okay? So what you want to do is, after the candle closes, and as you can see, it closes right here at this point right here. Do you notice how it closes right on the 200 moving average, which acts as support? Right on it, okay? Over to switch back here. Right on that 200 moving average, right there, okay? So check what you're going to do. When this red candle closes, okay, this green candle opens up. That is your target to buy. So even though you're buying on the red, what I should say is you're buying on the close of a red candle, and you're selling on the close of a buy candle. Just make note of that. You get in this trade, you're here. Okay, here's what's gonna happen. Here's what happens. You get a little red retracement again, and then check this out. So here's where you're gonna set your stop loss. Just below the cross. Your stop loss goes here. Now, where you close the trade is when you have, since you're going up, is when you have that sell candle close below your 14. Or you can have it wait until it closes below the 50. Okay? That's another strategy you could do as well, because the 50 kind of moves as a support line. So how much would you have generated on that? Well, you would have bought in right here. And if you bought in right here, you rode that all the way up. Yes, there are some downs. You don't mind that. You're following it, come down, but it's still a green candle that closes above the 14. So you pay no attention to that. Here is where you've got the sell candle that closes below your 14. So you might decide to close right here. How much pips is this? 52 pips is your profit. This is where you jump out. What is your risk? Well, let's see. Cross, you bought it right here. You put your stop loss here. Your risk is 14 pips. You risk 14 pips, stop loss. Your profit, all right? Your profit is 50 pips. Does that make sense? Let's look at another example. So again, you're here, bad example. Let's look at this one here. So we got another cross that is right here, okay? 14 above, it crosses the 50, downward movement, okay? So what do? Okay, you identify what's happening. It's a downward movement. 14 is below the 50. So you're gonna come, your stop loss goes just where? Just above the cross. Probably not even that high. Just above the cross, okay? This is where your stop loss goes. It may come back up and break your stop loss, but wouldn't you rather lose just a little bit than to lose a lot? Obviously. So here's what you're gonna do now. You wait for the retracement. Where would you have bought in on this trade? All right? Got the cross right here, pushes down, and then you want to get the retracement, and you want to make sure that retracement is around 10 to 11 pips. Now, I mean, just now I showed you 14, but that's just so you get an idea. About 10 to 11 pips. How much pips you got here? Okay. 9 pips. 98, 99. Call it 10 pips. Perfect. So you want to get a buy candle that is as close as possible to the cross. Okay? It comes down, and here's what you do. When do you buy in? Do you buy in here? Do you buy in here? Do you buy in here?
Buying on the close of the. You sell. Well, you're buying on the close of the buy.
Of the buy candle.
The
Correct.
buy candle.
Very
When that
good.
goes off. Yeah.
Very good. Now you realize that even with this candle, next after it, it goes back up and breaks the 14. But
Yeah.
does it really broke? Actually, it doesn't.
No.
The wick breaks it, but the candle itself is still above. It's still below.
No. Yeah.
Still some distance off. So that is a good sign. So let's look at what would happen. So we would have bought in at the close of the buy. So we would have bought in right here at the beginning of this new candle, and we're gonna write it down. Now it goes up. We get a break here. Does it break your 14? It breaks the 14. Yes. Does it break your 50? I've got some feedback. Someone is in the background is talking. I can hear a child. Can a person just mute their mic, please?
What? Oh, it was from yesterday.
Your Galaxy S6.
Okay, don't worry. All right. So I just muted everyone. Problem solved. If you want to make a comment, you can unmute yourself. All right.
Yeah.
Yeah, I think I put it that you can unmute yourself.
Yeah, you can unmute.
Oh, okay, good. Right.
Yeah, like you say, it just break the 14 MA, but it haven't reached the 50.
Correct. It hasn't hit your stop loss and it hasn't broken the 50. You're buying right here. Yeah. How much pips do we get? Well, it comes down, it retraces again. Even though it retraces, it still doesn't break the 50.
Yeah.
And guess what happens? So it respects that, it keeps coming down. We got a big wick here. Do you need to worry about that? No, you don't.
Nope.
You don't. Because only the wick breaks it. Okay?
Yeah.
And it still doesn't break the 50. You keep writing it. You write it. Now you're going to lose some between here and here. Yes, you could jump out here. But I mean, it could go further as well. So why not just hang in? It's not like you're in loss. You write it until you've got the buy candle that now breaks the 50.
Yeah.
This is where you jump out. It closes above the 50. You jump out here. How much pips is that? 44 pips.
Wow.
What is your risk? Your risk between where you bought in and where your stop loss is set.
About 10.
About 12 pips.
12, yeah.
Okay? About 12 pips. So 12 pips compared to 43 pips.
43.
Does the strategy make sense?
Very much so.
And it's very, very simple. All you need to understand is you wait for the cross, you wait for the retracement. And after you get that retracement, when that candle closes, if it closes below the 14, you're buying at the close of that candle and you're just writing it. Same thing happens on the flip side. Okay? Same thing happens on the flip side. I'm not going to work with those huge jumps or whatever. So here's another one. We've got a cross right here. Okay? Now, in this situation, you've got, by the time you get the cross, you've already got a massive movement going up. But you can probably tell it's about to cross. It's best to wait until it actually crosses. I know sometimes people kind of jump ahead and say, hey, this is definitely going to cross. They jump in, and it comes close, and then it does like this and reverses, and it doesn't cross. Then you mucked up. All right? So here's what happens. It goes up, goes up, goes up. Then you've got a huge retracement back here to the 14. But how much pips is this? Let's see. Between the retracement and the cross, 23 pips. You would not take this trade. You really don't want to give up that much pips. Okay? You want to have something about 10, no more than 10 pips. Sometimes it's 2 pips you get. Okay? Cross. Okay? So you set your stop loss just below the cross. Boom. Right down here. Not even that far. It's about here. So, after the cross, you got an upward movement, downward movement. You wouldn't buy in here either. I wouldn't buy in there for sure. I don't trust it. Line's too close. You got this upward movement. I would probably let this one go as well. You're not going to get all, guys. You're not going to get all. And don't ever chase them either. Had you bought in here, it's possible that you could have made some money. You could have rolled that right up. You got the green candle, you got the retracement, stop loss goes there, you buy at the close of that, and you just write it all the way up. All right? This comes down, but it closes above. This closes below. It doesn't break the 14 though. So you can actually close here for 52 pips. Or you let it ride. Let it ride, let it ride, let it ride, let it ride, let it ride. Guess what? Up there. Now you've got a big close below the 14. Well, actually, this one here closed below the 14. Not below the 50. This one closed below the 50. So if you wrote it all the way up here, 36 pips. 36 pips is your profit. What's your risk? Cross, you would have bought in, you said we would have bought at the close of that. Your risk, 11 pips. See that? So in all times, you want to risk as little as possible and make as much as possible. So even if you did this 36 pips and you were on a small lot size of, let's say, 0.02, okay? What's my calculator? Okay. So 36 pips, so which is 360 points multiplied by 0.02, $7.20. All right? May not sound like much, but if you do 5 trades in a day, multiply that by 5, that's 36 US. And you multiply that by, say, 6 days of the week trading, that's an extra $200 US per week. Just like that. When your lot sizes start to increase, 0.05 by the same, 36 points, it's 18 bucks on that one trade. 5 trades a day, that's 90 bucks a day. Average on 6 days, that's an extra $500 US per week. And these are small lots. This is 0.05 is what I just used. All right?
Nice.
Are there any questions? Okay. All right, well, guys, that's pretty much it. Like I said, I really didn't even want to go this long, but we did. I hope you guys understand a bit more about how to use the break points, how to find them, how to locate them, what to look for in terms of the M's and the W's. We also looked at the true supports, true resistance, and we looked at the EMA strategy and how to use the cross points. Okay, if you learn how to do that, you can make a ton of money simply, just almost on every trade. You can make money. Now, keep in mind, there are some things sometimes that throw you off, news, and something you just got choppy market. It happens. You're going to get some good weeks. You're going to get some not so good weeks. Good days, not so good days. That is the nature of Forex. If you don't want to lose money, get out. Period. All right? I really don't want to sugarcoat it for anyone. You can make a lot of money in Forex, but you can lose a lot of money as well. And you can lose it pretty fast. All right? And if you're not coming with the mentality and the mindset that there's a possibility that this money could be lost, if that scares you that much, you shouldn't be doing this. You shouldn't be. You cannot make $100,000 and afraid to lose 1,000. It's not going to happen. You can't expect to make millions of dollars over time, but you're afraid to lose a couple $1,000s. It's not going to happen. All right? So that being said, guys, trade hard, trade safe, get money. Ghost Effects out. See you guys back in Battle Room. And if you guys are trading today, just be careful. Remember that we're still in Asia consolidation period. 1, 2, we've got the gap times. That's going to happen between 3 and 3:30. I would not suggest trading around that period of time. And 3, tomorrow is a holiday in the UK. So even though London market is going to be open, it's very dangerous to trade on holidays because this is when market makers are going to take their profits and kind of steal your money as well. So keep those things in mind. Have a good one. See you in the battle room. And I'm going to go right ahead and stop recording right now. Have a good one, guys. Bye-bye.